Hi, Kelly Weber with the Weber Group here at RE/MAX in Oradell. Today I'm here with Brad Haberlin from Bond Street Mortgage. Thank you for joining me today.
Thanks for having me, Kelly, as always.
We're heading into the spring market, even though it doesn't look like it right now with the snow out. Myself as a realtor and Brad as a lender, this is the time we start preparing for the spring market to hit. So let's talk a little bit about the rates today versus where they were and where they're going.
Okay, that's a very important topic right now because rates and the market is very volatile, so they're all over the place. The rate you get today is not going to be the rate you get tomorrow, and I'm talking about day to day, not month to month. So,
and it never used to be like that.
It was pretty stable for a long time, and there's a lot of stuff going on with the China trade talks and job report numbers, and there's many things that make rates fluctuate. So one of the most important things that buyers need to know is that mortgage rates are not based off the Fed rate. So when you hear the Fed is hiking rates, everybody that wants to buy a house is freaking out because they think the mortgage rates are going to go up. The last couple times the Fed hiked the rate, mortgage rates actually dropped.
I remember that, yeah.
So make sure that your clients are in the know about how the mortgage rates are dictated, okay? The 10-year treasury yield is what makes mortgage rates move. So any little news about any little thing in the economy will make that 10-year bond change, fluctuate, okay? And a couple of the biggest things right now is oil and the trade, China trade talks. Okay, so that's making it very volatile right now as well.
Because when I talk to you, one day it's this rate and then it jumps and then it comes back down. So I'm glad you explained that because buyers today don't understand that.
Yes.
Today, what is the actual rate today?
So, I mean, rates are always,
For 30-year fixed.
type of property, loan to value, the more you put down, credit score, that all has an impact on rate. But if you're talking about A+ everything, right now we're about 4.5%. We're a bank, so we all get our money from the same places. Make sure when they're looking online to these obscure banks that they know that they're what they're looking at, because a lot of times those are with points involved. And buying down the rate is not always a bad option. If you're planning on staying in a house for 30 years, a rate buy down could be cost effective for you because your break-even point may be 4.5, 5 years, and everything after that is free money. So think of it as an investment standpoint where if I invest $5,000 today, I'll have my money back in 4 years, and then everything after that I'm making $1,000, $2,000 a year.
Absolutely.
So it's
and you know what? People don't like to hear that. They don't. The thoughts of putting money out up front,
scares people.
Yeah. But if you're going to be in a house for any length of time, I think that's a great option.
Yeah, I think it's a great option as well. And just make sure that clients that were looking, say a year ago, not even a year ago, October, September last year, rates were a lot higher. The 10-year was almost 3.25%. It's back down to about 2.75 right now.
And again, it's still low. People when they hear rates are going up, they're still low.
Historically they're still low. In 80s you're talking 18%, 90s 10, 11, 12%.
Yeah, that's
so
when I bought my house. My first home, and that was a lot of money. A lot of money in interest you paid there.
A lot of money in interest, So historically they're still low. Clients that were looking last year when the rates were higher are in a benefit. Clients that were looking a year and a half ago when the rates were 3.875, 4%, then they have to reevaluate where they were, because if you have
and it does, I didn't mean to interrupt you, but it does change the amount of money, the amount of home you can afford.
Correct.
When they start going up, it really does impact your purchasing power.
It does, to the point. Yes and no. So it affects your purchasing power, because if you were thinking about buying a house at this point with this rate and you were maxed out in your debt to income ratios, or you were borderline conventional, the FHA, that could put you over that threshold. So you want to always reevaluate today's market rate with your pre-approval and have that updated. But if you look at the other end of the spectrum, a $300,000 mortgage, an 8th in rate is about $25 a month. So I explain to people like this, like if they put it, and an extra $10,000 in your mortgage payment is only about $50 a month.
And you know what? People spend that on Starbucks.
Exactly. I sit down with clients and I educate them and I say, if you bring your lunch to work 2 days a week, you can afford the house you love. And they're like, wow, okay.
It makes sense
Yeah.
when you put it into terms like that. How can people get a hold of you? Because I love using Brad. He is wonderful. My deals always happen. They always go through, and clients are always very happy with you.
Thank you. I appreciate that. And same with you. Every time, nothing but good stuff
Thank
with
you.
when they use you
Thanks.
as well, Kelly. You can contact me at 201-983-2366 and bondstreetmortgage.com, and I have a personal page on there as well.
Good. Thank you so much for meeting me today. And you can always reach out to me as well, and I'll put you in touch with Brad. So thanks so much.
Thanks, Kelly.
And I want to get you on here again soon.
Great. Thanks.
Thanks.